Welcome back to Everything Money, your favorite YouTube channel. Isn't that nice to say, Paul? It's my favorite for sure. I'm Seth, Paul, and Mo in here. We're going to talk about Annalee Capital. Paul, you're going to call this what you're going to call it. So, Annalee Capital. This is a REIT. We get on our Patreon page in the Discord. Everyone asks about REITs. Paul, people love dividends. There's whole groups. People just invest in dividends. I've had patrons. I've done interviews with our patrons. They just love getting that check just sent to them from these dividends. And we've learned in the past that dividends aren't always safe.
Why is that, Seth?
Because if they don't have the free cash flow, like Geo Group, this prison system group.
Explain that situation.
Well, Mo, remember that we did a video on Geo Group, and they had a 11% dividend, something absurd.
Yeah.
Everyone loves this. And then there was some sort of, what happened where they didn't have the money?
What did we say in our video?
Well, we always say be careful.
We predicted it.
Yeah, well, yeah. I mean, I always said, I think what we said was like, hey,
this could be
a problem here. I don't understand how this is happening.
Yeah.
And then all of a sudden, a month later,
they pulled
because
it back.
They couldn't afford their dividends. So
they couldn't afford their dividend anymore. It's just like, okay, dividends
dividend.
are not guaranteed. Dividends are cash from operations less your capital expenditures. If capital expenditures are too high or cash from operations are too low, you don't have free cash flow. You can't buy back shares, pay dividends unless you take on more and more debt.
Right.
That's it. It's not going to come from the cash flow.
The ticker symbol is NLY. This is one of the largest mortgage real estate investment trusts. It's in New York City. The company borrows money primarily on the short term, repurchase agreements. They were founded in 1997, and their stock price got slammed last year. COVID, it's on its way up. Paul, let's take a look at Annalee Capital Management, baby.
Well, this is our Everything Money software, 80 cents a day, coming soon. Oh, no, it's already here, but we'll have more information on it. While Annalee's residential assets are primarily comprised of agency mortgage-backed securities.
Oh, boy.
Now, remember, guys, mortgage-backed securities have a negative connotation to them, a negative reputation to them. Why is that, Uncle Seth?
Well,
the Big Short.
Yeah, this is the premise of the Big Short. People were trying to make money on money, and they were making bets on bets, and it brought down the whole system in 2008.
Now, am I saying that this is like 2008? I'm not saying that. However, do I think residential real estate is a little hefty right now? Sure, I do. Is it as stupid as it was back then? Not that I recall, but also we had a crash back then, so who knows if I'm really remembering it right, but back then, everybody and their mother could get 18 mortgages on the same property with no income verification whatsoever. Mm-hmm. We don't have that anymore. Even me, I'm trying to get a mortgage on my new house that I bought.
Yeah.
And the bank sent me this questionnaire. Steve, my banker, was like, hey, Paul, there's some more questions on your numbers. And I'm like, are we serious right now, Steve?
You can pay for your new house multiple times over.
Yes. And he sent me these questions about my real estate portfolio. And the funny part was the numbers they assumed, that reading off my statements, were absolutely wrong to the low side. I was like, well, that's not correct. I actually make more than that on this one. So it's funny, they were at least asking me questions about that when I remember 12, 13, 14 years ago, meeting people who had no income whatsoever, literally going, oh, I just walk into a bank and I get a credit line immediately for a real estate loan.
Yeah.
Doesn't happen anymore. However, I want you to remember, this isn't a REIT in the sense of owning a lot of, from what I see from this, and remember, we do zero due diligence.
Yep.
Our goal on this channel is to understand the numbers first, and if the numbers make sense and have a story to tell that we want to learn more of, then we do due diligence. So everybody out there who says I didn't do my due diligence,
you're absolutely correct.
Duh.
Duh.
Okay? So I just want you to make sure they invest in a lot of mortgage loans. Just something to keep in mind that you're not actually buying apartment buildings, according to this.
What is the market cap for Annalee Capital?
$13 billion. PE of 2.8. That's probably drawing a lot of attention for people.
Low.
Yeah.
Profit margin, 93.45. Yeah, this is definitely not a REIT that's buying residential actual properties. They're buying mortgages with these huge, because what's the cost of buying mortgage-backed securities? You know what I mean?
Mm-hmm. Pillar number 3 is revenue growth over the past 5 years.
This is showing negative revenue. It's still a check mark on the revenue number, but there were quite a few years of negative revenue. So let's do a quick timeout here on the conversation. Guys, I'm a value investor. I believe in investing in what I understand. I don't want to understand why this happened. Somebody might sit there and say, well, you might be missing an opportunity. I don't get this. I immediately don't understand this. Looking at this immediately, revenues are really strange. I don't understand what the negative revenue means. Would it be easy to find out? Probably. Let's go to the next pillar. 75 million in profit, 4.5 billion, but they lost 5 billion the year before and lost 2 billion the year before that. Number of shares outstanding are probably increasing because they're a REIT. So $1 billion to $1.4 billion, X there. Let's go. You know what? Let's skip to the cash flow statement. And here's why. This is all about the dividend. The dividend is 9% per. Oh, we forgot to even show that, Seth. Do you see this?
Oh no, that's why we're here.
The dividend is 9.5%.
Good
so
Lord.
somebody had said to somebody we know, hey, look at this. Why don't you just buy this and retire? So it needs $1.23 billion a year to pay its dividend. That's the important part. So we go to our trustee cash flow statement, and we go to the middle section, the investing section. I make it easy for you. I added free cash flow line here. This is not normally in the investing section. It's nowhere. I just want to make it easy for our users. 1.3 billion down to a negative $23 billion. What? How do they even have money to, I mean, their average, even taking out last year, their average is still negative. Because they had 18 billion, I don't know. Like, to me, if you want to put your money in this for a dividend, I don't understand how they're making, I mean, I have to go really do more due diligence on how they make money, but I don't like the asset they're buying because I don't understand the asset they're buying. There's a lot of, these are, as Warren Buffett calls them, weapons of mass destruction in the world of finance. They're financial weapons of mass destruction. It's not to say that every mortgage-backed security is bad. It's just, it's a booming market right now. What happens when it's not a booming real estate market anymore? What's going to happen then when rates go up? Things like that. Are people going to want to buy the low? I don't know. This was a tough one. I just look at this going, I'm avoiding it.
Would you advise normal people like myself or our viewers into getting into this? Or I mean,
if you don't understand how they make money, you're not going to understand how they lose money. That's a statement I've created, and I actually love it. If you don't understand how they're going to make money, you're not going to understand how they're going to lose money. I'm sure I can figure out how they make money, but why? There are 10,000 stocks out there that make an actual product or service that I can understand much easier. Why go waste my time with this? For 9.5% dividend, to me, it's scary. I mean, the average, they basically borrow money to pay this dividend over the last 5 years. Because their average has been $5.5 billion in losses, and they pay out $1.3 billion a year in dividends. How do you make that work?
So Paul, can I just buy this, put a 5% stop loss, and just start getting 10% whenever they issue dividends?
Problem is, you might not be might drop 5% and you won't get that dividend. Just lose the 5%.
Oh, I see. Okay.
Yeah, I mean, I don't value invest with stop losses. I would trade with stop loss. I don't value invest with stop losses.
Well, let's do that. Mo, what are they doing on
so
Annalee management?
This is interesting. It's definitely a downtrend. There's no doubt about that. When the Fed came out last week and started talking about they're going to stop, they might taper their buying of mortgage-backed securities that they're doing every month, $120 billion every month between mortgage-backed securities and treasuries. That's when this thing started to turn. So I'm not saying that they're buying enough more. These guys are dealing with enough mortgage-backed securities, and the Fed's dealing with that. It's going to do. But that news right there made something happen. So this thing is certainly in a downtrend. If you keep getting this negative talk on mortgage-backed securities from the Fed that they're going to start tapering, maybe look out for this thing to start dropping on you. There's not much support in here except for this level, which is about $8.80 or something. So if it can break through there, you might have some room to run, especially with this news that's coming out and it's being pummeled in your face every single day.
By the time this video comes out,
speaking of news,
look at this, guys. The news portion of our website. Yep. We get news from CNBC, Seeking Alpha, which we love, CNBC, which we love, and Bazinga. Yeah, I don't know who Bazinga is. Who's Bazinga?
I don't know.
Sounds sexy.
Probably a good news outlet.
Yeah, enough for, but anyway, CNBC, Seeking Alpha, this is all great. We're adding this. We're going to add more news at some point. This is all great stuff. These are all articles just on Annalee Capital.
And
so if you want to get pummeled with mortgage-backed security news, everythingmoney.com.
Yeah, this is Everything Money. This is what you get as a patron. If this style of investing resonates with you, click on the link below to join our Patreon. A very strong number.
Look at this article right here. 19 days ago, Warren Buffett says, "Make income while you sleep." This is called clickbait because they're sitting there going like, "Oh, let's mention this," so people are going to be like, "Oh, cool. Warren Buffett likes the stock." That's not what it's saying, folks. That's not what it's saying. What they're saying is Warren Buffett says, "Make money while you sleep." Oh, you can make 10% dividend here, money while you sleep.
While you sleep.
All right.
That's our take on this company. Kind of screwy, huh, Paul?
It's a little weird. I just, you might sit there and say I'm too quick to dismiss. Yes, I'm going to dismiss that because I don't want to get involved. I mean, there's so many companies that provide actual services and products. Why would to understand their capital expenditures? What the heck is going on over there? I have no idea.
I see a lot of people who are really, really enamored with dividend investing. You're not really.
I like dividends.
Yeah, but you don't stress it a lot.
I always look at it like I love collecting dividends. Absolutely, it's great.
It's very tax inefficient, by the way.
But that's, to me, I always make the correlation. It's like going and buying an ice cream sundae for the cherry on top. Are you going to buy something like this just so you can collect that dividend? Just go buy the cherry.
Yeah, if you buy,
you know what I mean?
If you pay for the full ice cream sundae and you find out it's a bunch of dog poop underneath, then much for the cherry on top.
Exactly, and that cherry is going to go away too. That cherry was filled with poop also.
You would say it would pop your cherry.
What are you saying?
Seriously, like a bad company with bad fundamentals is like a dog poop underneath the cherry. It's like, hey, cool, there's a cherry on top, but it's like, yeah, but there's dog poop underneath it. Same thing. I just look at it saying, understand the dividend's safe and secure, and then go invest it. Remember, dividends are very tax inefficient. You're already being taxed. That's why I always tell people when they talk about the corporate tax is so low, dividends should be taxed higher. Cash coming from a company is already taxed at the corporate level. Then when they pay out their owners, aka you're taxed again. It's double taxation, right? So it's very tax inefficient. They just kept the money in-house and bought back shares and invested for growth. You'd get taxed later on down the road, and buying back shares, there's no tax consequence whatsoever for you as an investor. But people like dividends.
Do you want to show them a strong dividend company like AT&T and Everything Money Software? Maybe show them how they have the free. Now they're actually reducing their dividend because AT&T is merging with Discovery, or at least making a new company.
So what's another company with big dividends? Let's go to J&J. J&J, 2.5% dividend, which is double what the market is right now. Yeah. $10.6 billion a year in dividends. But look at this. Their free cash flow in the last year was $20 billion. And their average in the last 5 years was $18 billion.
So they have almost plenty of money to pay a dividend.
Plenty of money to pay a dividend. Which, by the way, I still think it's stupid they're paying a dividend. Well, I shouldn't say it's stupid. Pay down debt. So the other thing is it helps the cash flow of the company too. Because when they here's the deal. If this stock was a lot lower priced, I want them buying shares back. Because when companies reinvesting back in itself by buying back shares, if it's buying back shares at a high value, they're overpaying for their own shares. Mm-hmm. But they might like it saying, oh, look, 2.5% dividend, we saved money on that one. I'd rather just look at their debt structure and say, hey, are there any higher interest rate debts that we can put away by paying down the debt as opposed to paying these dividends? But everybody loves their dividends. The problem is, in order to get paid $10.6 billion in dividends, the company had to make $15 billion. And then you're going to get 10.6, it's going to become 7. So the company had to make $15 billion and you saw 7 in your pocket. Tax inefficient. That's over half. It's very, very tax inefficient. And that's why and not to get in politics, when people talk about the capital gains tax is so low and the corporate tax, it's so much, this is double taxation. You got taxed once on the income and as a company, and then once again when it goes to the shareholders. If you have an LLC, where I run my business here, I don't pay double taxes. Every dollar of the income goes to my personal statement. That's it. Mm-hmm. Same with you and your business
that's right.
For both businesses.
Yeah, both businesses. Yeah. All right, that's our take. Be careful on NLY. If you're investing in REITs, just be careful with this one. That's our take. Fondle the thumbs up on the way out. And patrons, you know I love you, and we'll see you later, guys. Thanks.